Hi folks, Tonto here. Wanted to take a little bit of time today to talk about some basic stuff with crypto. I want to talk about portfolio allocation. I want to talk about custodial and non-custodial wallets. And I want to talk a little bit about your expected return. So let's jump right into portfolio allocation. So for me, I'm in my 50s. I've allocated about originally 10% max of my portfolio to crypto assets. The other 90% was in traditional assets that you find mainly all mutual funds. What I found is over time though, as this bull market has started, that percentage and that allocation has gone up and gotten higher to about 12%, which is fine. I intend to leave it there, but for someone my age, unless you know exactly what you're doing, would highly recommend not putting more than 6, 8, 10, 11% of your total portfolio into crypto because of its volatility. It has a place, but not a big place. Now, if you're younger, those numbers might change. And in fact, some people, young people in their 20s, probably have 100% of their net worth in crypto. And that, I guess, is fine. That would make me uncomfortable, but I think for people that know what they're doing, that could be a reasonable thing to do, as long as you have a steady job and all the other bases are covered. But for most people, I think the 10% allocation lets you sleep at night. Now let's talk about where you're actually keeping your crypto assets. For me, 80% of that 10% allocation that I have are in custodial wallets. I have mine at Coinbase and an IRA company called Alto IRA. And what that means is that those firms have the keys to the wallets that contain that crypto. I know a lot of people are concerned about, well, not your keys, not your crypto. I'm not concerned about that. I'd rather have a professional keep those funds for me. Now, the other 20% though is in a non-custodial wallet, self-custody. I have the keys to the wallet and I am on the blockchain and I am doing stuff with that crypto, farming, airdrops, getting yield, all that kind of stuff. That's good. I own those keys. I can control that money. But the downside is you can also get taken advantage of very quickly. If you click on the wrong link or do something wrong, your funds are gone. And that's happened to me. I've done that. And that's cost me a lot of money. But I've learned. And because I didn't have all my assets there, I had some of them elsewhere offline in custodial wallets. It didn't have a big impact or an impact that I could overcome. So that's something to consider. I wouldn't recommend as a new user to put much more than that 20% in a non-custodial wallet until you learn what you're doing. And then if you want, maybe ramp it up. But unless you're really going to degen, I think there's always going to be a place for keeping, your basic coins, your basic assets, crypto assets at places like Coinbase or other kind of trusted third parties. The last thing I wanted to talk about today was expectations of returns. And I see this all the time in Discords where people have crazy expectations of the return they should get. Perhaps a lot of that is due to previous airdrops from the last cycle. Things like people deposit $100 or $1,000 and expect 100% return in 6 weeks or 8 weeks. That's not really realistic anymore. That's probably not going to happen at all anymore in crypto with airdrops. I think you can definitely get returns in the 50% if you're willing to do things like collect the tokens, stake them, and wait for a year or so. But I don't think it's going to be, 1,000% or 1,000,000% like you often see on Twitter for coins and stuff. I think it's good to keep your expectations in line. Think about things like, well, if you were invested in a traditional savings account or in the stock market, a great year would be 20% returns in the stock market. And if you're going to get 40%, well, that's great. Remember, it's risk adjusted, it's riskier, so it's higher. But again, that's doubling the return you could get if you used a traditional finance tool. So just keep that in mind. I would not expect crazy yields anymore, but you can certainly beat what you could get in traditional finance pretty easily in fairly low risk ways if you just look around a little.